You are probably familiar with how a loan from a bank works, but what about borrowing from your own Index Universal Life Insurance Policy, or IUL? If this is what you are trying to understand, you are in the right place. One of the key benefits of an IUL is easy access to your money. Unlike the typical retirement account, your money is not locked up. This flexibility makes IULs especially appealing. As long as you have cash value, you can borrow your money from your IUL policy for any reason. It's usually very straightforward, and there's nothing like a credit check or extensive paperwork. When it comes to IUL loans, there are two main types. We have participating loans, also known as index loans, and then we also have fixed loans, also known as wash loans. Beside loans, you also have the option of making a withdrawal. Let's look at how these differ from each other, starting with participating loans. Imagine you have $100,000 in cash value and you want to borrow $10,000. Here's how it works. We have the insurance company's account, your policy's cash value, and your bank account. I'm using different colors here just to make it a little bit visually easy to understand. The insurance company will send $10,000 from their account into your bank account. It could be a check as well, you get a point, and charge you, let's say, 5% interest. So they use your policy as a collateral for the loan. Your $100,000 cash value stays untouched, so it continues to earn interest as if you never took out a loan. This is very important to understand. You often hear people say, why pay interest on your own money? But that's not the case. If you have money in the bank and you withdraw a portion of it, the amount you withdraw doesn't keep earning interest because it's out of the bank. Let's break down how an IUL policy loan might work when the market conditions are favorable. You have $100,000 in cash value and you need to take out $10,000 to help pay for your daughter's college expenses. This leaves you with $90,000 in available cash value. Now the $10,000 loan comes with a 5% annual charge, so you would owe $500 for the loan. But let's say the market does well and the index you chose earns 8% over the year. That would give you $7,200 in interest on the remaining $90,000 in the policy. Plus, the $10,000 you borrowed also earns that same 8%, adding another $800 in interest. So even though you are paying $500 for the loan, your loan amount actually earns $800, leaving you with $300 in net interest. That's fantastic, isn't it? Now, let's consider what happens if the market doesn't perform as well. You still take out the $10,000 loan, leaving you $90,000 in available cash value, and you still owe that 5% annual charge, which is $500. But if the market index you chose doesn't do well and doesn't earn any interest, you won't get any credits on your loan amount. In this case, you would have to pay the full $500 for the loan without any offset from interest. Keep in mind, the interest your policy earns can change from year to year. There is no guarantee that you will earn any interest or that it will be enough to cover the cost of the loan. But in both of these examples, the loan charge will still be $500 each year. Even though I use a fixed interest rate of 5% in this example, some insurance companies have a variable participating loan, which means the rate is variable each year, but usually with a cap or upper limit. For example, it's variable, but it might not exceed 6%. So you know the worst case is 6%. Let us look at the same scenario, but this time with fixed loans, also called wash loans. We have the same accounts as we saw previously with $100,000 in cash value, and you want to borrow $10,000 using a fixed loan. This time, there is an extra account, a fixed account managed by the insurance company, which earns at a fixed rate, let's say 2% in this example. The insurance company will lend you $10,000 from their funds and charge you a fixed interest rate of, say, 2%. This time, they will transfer $10,000 from your cash value to the fixed account that also earns 2% interest. This means your index account will have a balance of $90,000, meaning only $90,000 is available for growth. The 2% interest you are paying on the loan is offset by the 2% you are earning in the fixed account. So the costs balance out, resulting in no net cost to you. Hence, it's called wash loans. Looking at the numbers, you have $100,000 in cash value and you need to take out $10,000 using fixed loan. This leaves you with $90,000 in available cash value. Because this is a fixed loan, the insurance company will move $10,000 into the fixed account. Now that $10,000 loan comes with a 2% annual charge, so you would owe $200 for the loan. Let's say the market does well and the index you chose earns 8% over the year. That would give you $7,200 in interest on the remaining $90,000 in your policy. Plus the $10,000 in the fixed account also earns at 2%, adding another $200 in interest. The loan charge is offset by the interest from the fixed account, hence zero cost or wash loans. I want to be very transparent here. Most IUL products will have some cost in the first 5 to 10 years before a fixed loan truly becomes a 0% cost. So which is better, index loans or wash loans? Wash loans are a good choice if you prefer a conservative approach because we know exactly what is going to happen. On the other hand, index loans are appealing because they offer the potential for an arbitrage or gain, meaning if the index performs well, you could earn enough to cover the loan cost and even profit. However, the downside is that you can't predict how the market will perform when you take out the loan, but you can take a guess based on how your policy has been performing over the years. Other than loans, another way to access money from your policy is through a withdrawal. With withdrawal, the money comes directly from your cash value. For example, if you have $100,000 in cash value and you withdraw $10,000, your remaining cash value will be $90,000. It's pretty straightforward. However, there are a few important points to keep in mind. Any amount you withdraw above the cost basis, which is the total amount of premium you've paid into the policy, will be subject to income tax. For example, if you've paid $20,000 in premiums into the policy and your cash value has grown to $25,000, withdrawing $22,000 will mean that $2,000 of it will be taxable. Because of this tax impact, withdrawals are not often used. Another reason is that anytime you put money into a policy, you will incur a premium charge. If this is new to you, check out my video on IUL expenses. I covered all this in details. I'm going to put it in the description below and also somewhere up here. So if you plan to repay the money, a loan is a better option. On the other hand, at retirement, when you don't plan on repaying, withdrawing up to the cost basis and then switching to loans can be a better strategy. Here are a couple of important points to keep in mind also. Some companies give you the flexibility to switch between different loan types on your policy anniversary. For example, if you currently have an index loan, but you anticipate that the market might not perform well in the upcoming year, you could switch to a fixed loan. It's important to know that not all companies offer this flexibility. In some cases, you may be required to pay off the existing loan in full before you can switch to a different loan type. Most IUL policies have a fixed fee when you choose to make a withdrawal, so this is something you should bear in mind. Let me know which other topics you would like me to cover in the comments below. Also, feel free to add any questions you have. I'll respond to each one personally. Don't forget to like, subscribe, and hit the bell so you never miss a video. I am Gilbert, and I'll see you in the next one. Bye.